one thing I never understood is when I hear other financial advisors and retail traders alike say, oh, the price of the shares are too high. Let's wait for the stock to fall so we can get in at a more favorable entry point. It blows my mind because you're just going to wait to enter into a position that you want to own instead of taking advantage of other opportunities to make money while you're waiting to buy the stock at a lower price. So here's a real simple strategy. Unfortunately, a lot of people know it works, but even more people, even in the professional industry of finance, financial advisors, planners, etc., think that it's such a risky strategy, and it just absolutely blows my mind. So today I'm going to go over selling put options and what the risk actually is and why you should do it. If you're truly wanting to own 100 shares of a stock, let's just say XYZ stock, and it's currently trading at around $100 a share, and it's had a big run up, or maybe it's fallen a little bit, but it's still a little high and you don't want to purchase it. But you would be okay with saying, hey, if it drops another 10%, 15%, then I'm okay with going ahead and buying the shares. What most people seem to do is put in buy limit orders. I'm only going to buy the shares at this limited price, nothing higher. That's fine. But why not just sell a put option, which is the exact same thing as a buy limit order, except you get paid for it? So if XYZ stock is trading at $100 a share, instead of just waiting for it to fall, you sell a put. And let's say you are okay with it falling another 10% and you'll enter into the position. Great. So that would be a $10 drop on your $100. So you're going to look at the $90 strike. And in this case, $90 strike, and let's say we'll look about 30 days out. Well, if that put option is selling at a, let's say, $3 premium, and I'm just throwing a number out there. If it's selling at $3 premium, we sell that. A put option is the right, when you buy a put option, you have the right but not the obligation to sell 100 shares of a stock at a certain price at a certain date in the future. If you're selling the put option, you have the opposite. You don't have the right or the obligation. In fact, you're just selling the contract. And so if the person exercises that right to sell the shares, you're the one that has to buy the shares, and you buy it at the $90 strike. So if we sell a $3 put option on the $90 strike, that's $3 times 100 for 100 shares. You would collect $300 in cash. Now, here's where the good part comes in. Since the current price of the stock is trading at $100, this is all extrinsic value or time value. And because options have extrinsic and time value, as it gets closer to expiration date, if that stock is not at or below $90, then this every day becomes more and more worthless. And if you're the seller of the contract and that contract is becoming more and more worthless, someone has purchased a worthless contract from you, and as the value declines on that contract, you are earning more and more money. Now, your max gain here is the $300. That's fine. However, what is your risk? Okay, if the stock goes down to $90 or below, you'll break even because you keep the premium no matter what. Again, we're doing this to purchase the shares. Your risk is you have to buy 100 shares at $90. So 90 times 100 is $9,000. That is what you would pay for the shares, but you're buying the shares. If you bought the shares at $100 and 100 shares, you would have had to have paid $10,000. So it's no different than buying at a discount down here. The other good thing is you actually get to keep this premium. So it's the strike price minus the premium you received, which would be in this case $300 with the $3 because they do it on a per share basis. So it'd be 90 minus 3, which is $87 a share. So you would actually have lowered your cost basis, and you would have purchased this for $8,700. And again, you're in it for the long term. You have now bought the shares at a 13% discount. Guess what? If the stock stays above 90, this expires worthless and you made $300. Instead of waiting around to own a stock at a lower price that may not even go down to the price you want to buy it at and making no money at all. So that is selling put options. The other thing, people always think, oh, you sell naked puts, you're going to lose all your money. Only reason you're going to lose all your money is if the stock goes to zero. And what are the chances of that? If you're buying it on a good fundamental stock, then you're willing to take the risk anyway because you're willing to buy 100 shares and own the shares anyway. It's no different than if you would have bought 100 shares. Selling the put option is no more risky. Financial advisors, I cannot believe you do not utilize this strategy. Some do, but most don't. And it is a very efficient way, and it's also the most profitable way because it has the highest probability of success out of any trading strategy other than buying and holding for the long term.